Hey everyone, welcome back to Corporate Decoder, the place where we try to understand what the big corporations are really trying to tell us, and sometimes even what they are trying to hide. Today we are diving deep into a shareholder report from World Funds Trust, or more specifically, the Union Street Partners Value Fund. Now, you might be thinking, shareholder reports, snooze fest. But trust me, there are always hidden gems and financial stories buried in these documents. We're going to break down their performance, their costs, and what they invested in. All in plain English, and before we dive in, if you love getting these kinds of insights from dense corporate filings, make sure you are subscribed to the channel and join our Discord community linked in the description below for more discussions like this. Alright, so this is an annual shareholder report covering the period up to the 30th of September 2025. Essentially, it's a yearly checkup on how a specific investment fund, the Union Street Partners Value Fund, has been doing. Think of it like a report card for your money if you had invested in this fund. They break it down by different share classes, Class A, Class C, and advisor class. This is important because different share classes can have different fees and performance implications. This report is filed with the US Securities and Exchange Commission, or the CC. It is a formal document detailing the fund's performance, holdings, and financial health. The exact name of the registrant is World Funds Trust, and they operate as an investment company. Let's talk about the cold hard cash. What did it cost to own a piece of this fund? For a hypothetical $10,000 investment, the costs varied depending on the share class. For Class A shares, the cost was around $146, which is about 1.40% of that investment. For Class C shares, it was a bit higher at $223, or 2.15%. And for advisor class shares, it was the cheapest at $120, or 1.15%. So right off the bat, we see that some share classes are more expensive than others, and that is typically due to sales charges or ongoing fees. Now, for the big question, how did this fund perform? For the period from September 2024 to September 2025, the Union Street Partners Value Fund, Class A shares without a load, which means without an immediate sales charge, returned 8.71%. That sounds okay, but let's put it in context. During the same time, the S&P 500 index, a commonly watched benchmark representing the broader stock market, returned a much higher 17.60%. Their other benchmark, the Russell 1000 Value Index, returned 9.44%. So the fund basically kept pace with the value index but significantly lagged behind the overall stock market. The report also tries to explain why they performed the way they did. They mention the AI boom as a positive factor, helping their information technology and communication services sectors. They also point to large banks doing well due to a better regulatory environment and more deal, making, however, the healthcare sector dragged them down because of falling drug prices and uncertainty. This is a pretty standard explanation, but it highlights how even a value fund can be influenced by broad market trends. This table shows how a hypothetical $10,000 investment would have grown over time. Looking at the most recent year, September 2024 to September 2025, that $10,000 investment in the Union Street Partners Value Fund Class A with a load grew to $27,016. Compare that to the S&P 500 index, which grew to a whopping $41,529 from the same initial $10,000. The Russell 1000 Value Index also grew more to $27,691. This clearly shows how much the fund has underperformed the S&P 500 over the long haul. Here is a look at where the fund's money was invested by industry sector as of the 30th of September 2025. Information technology makes up the largest chunk at almost 20%, followed by financials at over 16%, and communication services at over 12%. You can see also they have smaller stakes in sectors like real estate and utilities. This tells us their investment strategy leaned heavily into tech and finance for this reporting period. And who were the big players in their portfolio? The top 10 holdings show a heavy concentration in large, well-known companies. Microsoft Corporation accounted for 9.38%, Meta Platforms Inc. was at 9.21%, and JP Morgan Chase & Company was the third largest holding at 8.40%. Apple Inc., Goldman Sachs Group Inc., and Dollar Tree Inc. also feature prominently. This shows a clear focus on large cap established companies, which aligns with a value investing approach, but also reveals some significant bets on individual companies. As of the 30th of September 2025, the fund's total net assets were about $84.5 million. They held 26 different investments. The total net advisory fee was around $499,000, and the portfolio turnover rate was relatively low at 12.93%. meaning they were not actively buying and selling a lot of holdings within the year. This suggests a more buy and hold strategy. We see a similar performance breakdown for Class E shares. Performance here was slightly lower than Class A, returning 7.76% for the year, again significantly lagging the S&P 500. The key factors affecting performance and the sector and top holdings breakdown are identical to Class A, which is expected since they are the same underlying fund, just different share classes with different fee structures. And for the advisor class shares, performance was slightly better than Class A at 8.95% for the year, but still lagging the S&P 500. The inception date for this class is the 27th of April 2016, which is later than the other classes. Importantly, the advisor class shares had the highest net asset value per share at $33.8. And the lowest expense ratio net of fee waivers, which is typical for advisor classes often sold through financial advisors, where brokerage firm relationships are key. This section is about the company's code of ethics. They confirm they have one that applies to their top executives, and there have been no changes to it during the reporting period. They also state no waivers from the code have been granted. This is standard corporate governance stuff, mostly to assure investors that the company has rules in place for its leaders. Here, the company states they do not have a specific audit committee financial expert on their audit committee. However, they believe the collective experience of the committee members is sufficient for their level of financial complexity. This means they think the whole team's financial know-how is good enough even without one designated expert. This table details the fees paid to their main accountant. For the fiscal year ending the 30th of September 2025, they paid about $15,950 for the audit of their financial statements and $3,300 for tax-related services. No fees were paid for audit-related services or any other services. The audit committee approves all these services. This indicates a straightforward relationship with their auditor. This is where we get into the nitty-gritty of the fund's financial statements. This is the meat and potatoes, the actual list of what the fund owns. As of the 30th of September 2025, they had about 99.39% in common stocks. Breaking that down, communication services is at 12.60% with holdings in Meta Platforms Inc. and the Walt Disney Company. Consumer discretionary is 11.62%, including Home Depot Inc., LVMH, Mott Hennessy, Louis Vuitton SE, Nike Inc., and Starbucks Corporation. Consumer staples is 9.18% with Diageo plc ADR and Dollar Tree Inc. Energy is 7.88% with Chevron Corp. And Exxon Mobil Corp financials are a big chunk at 16.59%, featuring Bank of America Corp, Goldman Sachs Group Inc. And JP Morgan Chase & Company Healthcare is 9.19% with Johnson & Johnson Merck & Company Inc. And United Health Group Inc. Industrials make up 7.01%, notably the Boeing Company and FedEx Corp. Information technology is almost 20% with Apple Inc. Intel Corp and Microsoft Corp. Real estate is 2.82% with Simon Property Group Inc. REIT. And utilities is 2.75% with PG Torp. They also have a small amount, 0.57%. in a money market fund. This statement gives us a snapshot of the fund's financial position on the 30th of September 2025. Total assets were roughly $84.5 million, with investments making up the vast majority of that. Liabilities were quite small at just over $60,000. This means the fund's net assets, which is basically what the investors own, were about $84.4 million. This is a healthy sign that liabilities are very low compared to assets. This statement shows the fund's income and expenses for the year ended the 30th of September 2025. Investment income, primarily from dividends, was about $1.4 million. The total expenses were around $1.2 million, but the advisor waived about $282,000 in fees, bringing the net expenses down to roughly $955,000. This resulted in a net investment income of about $459,000. On top of that, they had realized gains on investments of over $1.2 million and unrealized gains of over $5.2 million, leading to a significant increase in net assets from operations of nearly $7 million. This shows that while the fund generated some income, its growth was largely driven by the appreciation of its investments. This table shows how the fund's net assets changed over the past couple of years. For the year ended the 30th of September 2025, the net increase in assets from operations was over $6.9 million. Shareholder distributions were about $118,000. Capital stock transactions, which include buying and selling shares, led to a decrease of just over $1 million in net assets. Overall, the net assets increased by over $5.7 million that year. For the previous year, 2024, the fund saw a larger increase in net assets from operations, over $11.8 million, but also had larger distributions and capital stock transactions, resulting in a net increase of nearly $12 million. These tables provide per share data throughout each year for the different share classes. Looking at class of shares, the net asset value per S-share at the end of September 2025 was $33.29. The total return for the year was 8.71%, aligning with our earlier performance figures. The expense ratio, net of fee waivers, was 1.40%. For Class C shares, the net asset value per S-share was $31.39, and the total return was 7.76%, with a higher net expense ratio of 2.15%. Advisor class shares saw a net asset value of $33.8, a total return of 8.95%, and the lowest net expense ratio of 1.15%. These numbers confirm the performance and cost differences between the share classes. This section is pretty technical, but it gives us important context. The fund is a series of world funds trust, and it aims for capital appreciation. They use fair value accounting for their investments, which means they value their holdings at their current market price. They primarily invest in publicly traded securities, so most of their investments are valued using level 1 inputs, meaning readily available quoted prices in active markets. This is good because it means their valuations are generally transparent and not based on subjective estimates. The report details how they monitor level 3 assets, but confirms they held none at the end of the reporting period. This is crucial. The investment advisory agreement is with Union Street Partners LLC, and they have a sub-advisory agreement with McGinn-Penninger Investment Management Inc. The main advisor, Union Street Partners, gets a fee of 1.00% of net assets, and they pay McGinn-Penninger 0.50% from that. McGinn-Penninger, the actual money manager, is paid less by the fund than they charge for similar separate accounts, which is a positive sign. They also mention that Union Street Partners has agreed to waive fees and pay for operating expenses to keep the fund's total annual expenses down to 1.15%. This waiver is important because it directly benefits shareholders by reducing their costs. For the year, they waived about $282,000. This table shows how the distributions paid to shareholders were characterized for tax purposes. For the year ending the 30th of September 2025, all distributions were from ordinary income, totaling just under $119,000. For the previous year, distributions were significantly higher, over $544,000, also from ordinary income. This tells us about how the fund is generating income and returning it to investors. This is the auditor's stamp of approval. Cohen & Company Ltd has audited the financial statements and states that they present fairly, in all material respects, the financial position of the fund. This is reassuring as it means an independent third party has reviewed the financials and found them to be accurate. They've been the auditor since 2010, which suggests a stable relationship. This section is a lengthy discussion on why the Board of Trustees approved the continuation of the investment advisory agreements. They reviewed factors like the quality of services, investment performance, costs, economies of scale, and conflicts of interest. They noted that the Union Street Fund underperformed its benchmark index and peer group for various periods, which is a bit concerning regarding investment performance. However, they concluded that the fees were fair and reasonable after considering the expense limitation arrangements. This is a common fiduciary duty exercise for fund boards. Now, looking at the whole picture here, the Union Street Partners Value Fund clearly has a strategy focused on established companies, especially in technology and financials as of September 2025. The performance is a mixed bag. While they managed to achieve positive returns, they significantly lagged behind the broader S&P 500 index over the reported periods, especially when looking at the cumulative performance tables. The fact that they are heavily invested in a few large tech companies like Microsoft, Meta, and Apple means their performance is very tied to these specific companies' success. The expense limitation agreement and fee waivers are a definite positive for shareholders, as they help mitigate some of the costs associated with investing. However, the underperformance relative to a broad market index like the S&P 500 is a significant point of concern for any investor. It makes you wonder if a simpler index tracking fund might have provided better returns for the same or even lower cost, especially given the fee differences across share classes. So, what's our take on the Union Street Partners Value Fund? They are operating with a clear investment philosophy, but their recent performance, particularly compared to the broader market, raises some questions about their ability to consistently outperform. The fee structure, especially with the waivers, is a good thing, but it doesn't negate the performance gap. For investors in this fund, it is crucial to weigh the management's explanations against the actual numbers. If the goal is simply to track a value index, they are doing okay. But if the goal is to beat the market, there is significant room for improvement. Investors should also pay close attention to the expense ratios of different share classes, as they can eat into returns over time. Alright, that is our deep dive into the Union Street Partners Value Fund's shareholder report. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. And don't forget to check out the Discord community in the description below. Thanks for watching. See you next time.